Welcome to Hidden Finance, the channel where economics and finance reveal their most hidden secrets. Today, we'll uncover a new mystery that has shaped global markets and influenced the economy. In today's video, we're diving deep into one of the most pivotal events in modern economic history, the energy crisis of the 1970s. It was a time when the price of oil skyrocketed, throwing the global economy into turmoil and bringing an end to a period of unprecedented economic growth. But what exactly happened? And how did this crisis set the stage for the world we live in today? Let's find out. To understand the origins of the 1970s energy crisis, we need to go back to the Middle East and the Fourth Arab-Israeli War, also known as the Yom Kippur War. In October 1973, Egypt and Syria launched a surprise attack on Israel, hoping to regain territories lost in the Six-Day War of 1967. Initially, the Arab forces made significant advances, but Israel, with substantial support from the United States and other Western countries, managed to repel the attackers. The direct involvement of Western powers, particularly the U.S. in supporting Israel, enraged many Arab nations. They viewed the West's actions as another example of its imperialistic meddling in the affairs of weaker nations. This sentiment wasn't new. It had been simmering for years due to a long history of Western interference in the Middle East, South America, and Africa. The 1973 support for Israel was just the tipping point. Recognizing their leverage, Arab oil-producing countries, under the umbrella of OPEC, the Organization of the Petroleum Exporting Countries, decided to use oil as a weapon. On October 17, 1973, OPEC members announced an oil embargo targeting countries that supported Israel, including the United States, the Netherlands, and several others. The decision sent shockwaves through the global economy, as these nations relied heavily on Middle Eastern oil to power their industries and economies. The embargo caused an immediate and dramatic increase in oil prices. In just a few months, the price of crude oil quadrupled, going from $3 per barrel to over $12. For oil-dependent nations, this was a disaster. With less oil available and prices soaring, they had to contend with rapidly increasing costs for energy and transportation. This, in turn, led to higher production costs for virtually all goods, from basic necessities to manufactured products. Governments around the world were forced to take drastic measures to conserve energy. In the United States, for example, gasoline was rationed, and there were long lines at gas stations. Across Europe and the U.S., governments implemented policies to reduce electricity and fuel consumption. Speed limits were lowered, and efforts were made to cut down on unnecessary travel. The aim was to preserve what little energy was available for essential uses and to prevent the total collapse of their economies. The economic impact was severe. Inflation rates soared as the cost of goods and services increased. In the U.S., inflation doubled from 3.2% in 1972 to 6.2% in 1973, and it kept climbing. Other countries faced even more drastic increases. This period of rapid inflation, combined with stagnant economic growth, gave rise to a new economic phenomenon: stagflation. Stagflation was a shock to the economic systems of the West. Prior to the 1970s, most economists believed that inflation and economic stagnation could not occur simultaneously. According to Keynesian economic theory, which was dominant at the time, inflation was a sign of an overheating economy, not one that was stagnating. The traditional Keynesian response to a slowing economy was to increase government spending to stimulate demand. However, during the 1970s, when governments tried this, it only made inflation worse without improving growth, leading to an economic policy conundrum. The inability of governments to control inflation while also stimulating growth led to widespread disillusionment with Keynesian economics. People began to question the role of government intervention in the economy. As a result, economic thinking shifted towards neoliberalism in the 1980s, which advocated for reduced government spending, lower taxes, and a greater reliance on free markets. The oil crisis of the 1970s had long-lasting effects that reshaped the global economy in multiple ways. Permanent changes in energy prices. The days of cheap oil were over. The crisis pushed the average price of oil from $7 per barrel in the 1960s to $26.50 in the late 1970s and early 1980s. Even after the immediate crisis abated, oil prices never returned to their pre-crisis lows. By the 2000s, prices had surged again due to rising demand from newly industrialized countries, such as China, which further cemented high oil prices as a new normal, shift towards energy efficiency and alternative energy. In response to the crisis, many countries sought to reduce their dependence on foreign oil. This led to investments in alternative energy sources such as nuclear power, solar, wind, and hydropower. Additionally, there was a push for greater energy efficiency across all sectors. Automobiles became more fuel efficient, homes better insulated, and industrial processes optimized for energy use. Transformation of global geopolitics. The crisis also had significant geopolitical ramifications. It underscored the strategic importance of the Middle East and led to increased tension between oil-exporting countries and the West. The reliance on oil imports also prompted countries like the United States to rethink their foreign policy strategies and focus on securing energy independence. This strategy included ramping up domestic oil production and exploring alternative energy sources. Financial market changes. The energy crisis coincided with the collapse of the Bretton Woods system in 1971, which had previously pegged currencies to the US dollar and gold. With the end of this system, global currencies began to float freely, adding a layer of volatility to international trade. This change, combined with the inflationary pressures from the oil crisis, led to a more complex and uncertain global economic environment. Impact on inequality. The economic turmoil of the 1970s also contributed to rising inequality. As inflation eroded purchasing power and unemployment rates increased, the gap between the rich and the poor widened. Those who owned assets like real estate or stocks often saw their wealth grow, while those who relied on wages saw their real incomes shrink. Looking back at the energy crisis of the 1970s, we see a world that was caught off guard by its dependence on a single energy source. Today, the situation is different in some respects, but similar in others. Oil and gas remain crucial to the global economy, and price shocks can still cause significant disruptions. However, we have more tools at our disposal now, such as renewable energy technologies and more sophisticated economic models. The key takeaway is diversification and preparation. Countries must continue to diversify their energy sources and invest in renewable energy to reduce their dependence on oil and gas. Energy efficiency should be a priority across all sectors to minimize the impact of potential future shocks. Furthermore, learning from the past, governments should be wary of over-reliance on any single energy source or economic strategy. So, what do you think? Have we learned our lesson from the 1970s, or are we still vulnerable to the whims of oil prices? If you enjoyed the video, leave a like and subscribe so you don't miss the next mysteries of the economic world. But what's your opinion? Share it in the comments.